Hello, investors and traders. Everything is unfolding according to our planned statements for 2024. As we stated, we are in a bull market this year. Do not sell and certainly do not short. And guess what? We were right. Our recommendations to buy Nvidia, ARM, and semiconductors have proven to be spot on. Cryptocurrency is also having a great year, just as we anticipated. While this bull run won't last forever, it's definitely going strong this year. In our upcoming videos, we'll discuss what's next for this market and why. If you find value in this content, please consider subscribing to our channel for more insights. Let's keep winning together. The late Marty Zweig famously advised investors with two key principles: don't fight the Fed and don't fight the tape. Currently, the Federal Reserve is signaling a shift towards rate cuts rather than hikes, with projections indicating the possibility of 2 to 3 rate cuts this year. This easing stance from the Fed is supporting the bullish momentum observed in the market. Moreover, the tape or the collective action of the market is providing clear signals of a bullish trend. This is evident from historical patterns such as the presidential election cycle and the broad rally across various sectors, not just a select few this month. Despite an increase in projections for economic growth and inflation by the Federal Reserve, they have maintained their stance on rate cuts rather than rate hikes. This indicates a commitment to further easing measures which align with the upward trajectory of the market. Reflecting on the Federal Reserve's actions in January when they embarked on a historic rate hike cycle, one might have expected a significant economic impact. However, the emergence of alternative sources of capital, particularly in the private credit market, has cushioned the effects of the rate cuts and other capital market activities. This resilience in the face of tightening monetary policies underscores the robustness of the current market environment. The markets are poised to register 5 consecutive months of gains, indicating a strong bullish trend. Despite concerns about overbought conditions, it's important to recognize that this market momentum is likely to persist in the intermediate term. However, it's crucial to remain mindful that next year may bring a different narrative, potentially leading to a bearish market outlook. In navigating these market dynamics, it's worth heeding the timeless wisdom of Marty Zweig: don't fight the Fed and certainly don't fight the tape. This underscores the importance of aligning investment strategy with the prevailing market conditions and central bank policies, as well as respecting the collective actions of the market participants. U.S. stocks rebounded Wednesday after several days of red closing as the S&P 500 jumped to a fresh record and Dow surged more than 470 points. The S&P 500 was up 0.8% to close a record of 5,248.50. The blue chip Dow Jones Industrial Average rose above 1.2%, and the Nasdaq gained 0.5%. The stock rebound came after a 3-day losing streak for the benchmark's S&P 500, where it set a new record closing high more than 20 times this year, and the gains extend beyond the start of 2024. The index is on track for its 5th straight monthly gain, and that could be a signal poised to run further. As we told you, this is not signs to short into the market, but still signs to buy on the pullbacks. Later this week, investors will see the latest reading of the Personal Consumption Expenditures, PCE, price index. The index, which contains the Federal Reserve's preferred core PCE inflation measure, is set for release on Friday. Also in focus is the return of the meme stock, the mania around the companies that have become phenomena on social media. Investors need to not look further than Reddit, RDDT, which as a platform has been responsible for much of the frenzy over the years. Reddit stocks had doubled from its IPO price, though it fell 11% on Tuesday as the stock gained short interest due to its recent surge. Meanwhile, shares of Trump Media and Technologies, DJT, the social media startup founded by presumptive Republican presidential nominee Donald Trump, gained another 14% after Tuesday's 16% gain. But perhaps the OG meme stock GameStop plunged 15% after reporting what one analyst called an unsustainable sales decline and announced job cuts. A stealthy rotation to sectors dominated March's trading action. Marches are just about over, and it has definitely been a month of rotation in the stock market rally. We will do further videos about these sectors of March and how you could possibly profit from them. As of Tuesday's close, energy XLE had been the largest, outperforming, gaining more than 9%. Meanwhile, materials XLB, utilities XLU, communication services XLC, financials XLF, industrials XLI all beat the returns of the S&P 500 for the month. Notably, this put financials, energy, industrials year-to-date performance above that of the benchmark index, furthering signs of broadening out of a market rally from one that had largely been driven by gains in tech and communication services, which contains several large tech companies. What happened so far this year is more signs of a broadening under the surface. Sectors that have outperformed are particularly tied to economic growth, while the sectors that have lagged the S&P 500 this year, like consumer staples, would typically be considered defensive plays utilized when investors are preparing for an economic downturn. What we're arguing is that the move in stocks to star this year is reflecting one, conviction in the AI growth opportunity, but two, is also reflecting increased confidence in soft landing. Multiple strategies have this rotation likely has further to run if the economic outlook remains intact or improve. If we were to see the economic growth deterioration, even if it meant that the Fed can't justify starting to ease sooner and ease more aggressively, you would see, even if you didn't see a major corrective phase for the indexes, you would probably see under the surface a shift away from more cyclical areas, probably back to more defensive plays. As of filming this video, our mantra of being bullish this year, no matter how overbought we get, is working out very well. Disclaimer: the information provided on our channel is for educational and informational purposes only and is not intended to be a substitute for professional financial advice. Protect your capital by all means. Our first focus is a top-down approach. What is the larger picture telling us? There are many factors analytically, historically, and technical analysis wise that this year will be higher. So why would we short into something that is going up? What is our trading edge? We have over 100 indicators that give us a weight of evidence to predict the overall market, and we are looking for high probability. We are also very consistent in our approach, using a rule-based system empirically, theoretically, and psychologically. We started a series to build your own rule-based strategy video, volume 1, issue 1, which is out. Decoding investing with logic. What is the overall market? Bullish. Which sectors are going up? Well, we've been telling you about AI, semiconductors, for the last 1 year, 3 months, but today we're also discovering some other sectors. Our short term is neutral because of overbought readings, but intermediate term and long term, we are very bullish. We're using a data-driven approach to maximize our success and looking to increase the probability of achieving. We are based on a rule-based decision and top-down. We are building a system of set of rules that guide your decision-making process while considering multiple sources of evidence and again being consistent. The first thing that I want to look at is stage analysis. As of today, S&P 500 securities, 66% are in a growth phase and 34% are in a bearish phase. Even though the NASDAQ is going up higher, 45% of the stocks are in a growth phase and 55% are either in a distribution or declining phase. These are definitely warning signals that a sell-off could happen. But if we go to what our next approach of what to look for when buying, the first thing I want to look for, are we in a bull market? If you look at the QQQs for a year and 4 months, we've clearly been in a bull market. Number two, are we oversold on this market? We've been neutral for the last 3 months on the oversold indicators. During years, during times, certain indicators will work better than other indicators. And usually during a bull market, these oversold indicators will never reach a real good time to get in, and the overbought indicators will always go higher. So thus saying that, we must use a weight of evidence to see that we are going straight upwards, and any type of pullbacks to buy, even though A lot of the oversold indicators will not give you a chance to get in. We avoid cheap tricks. We do not buy because something's hitting 52-week lows. More, we like things hitting 52-week highs to say this is a good opportunity. We prioritize uptrends. We exit downtrends promptly, and we're maintaining consistency. Based on these scenarios, since January 18, 2023, we have been bullish on the QQQs, getting in at 284 with a current price of filming of 443 with a 56% long-term gain just off the QQQs. We are looking to buy the QQQs on any types of pullback, especially because we think short-term we are neutral, and we are definitely not shorting into the market. A lot of these indicators will not be giving you good signs that have worked in the previous years, but again, we are using a weight of evidence, like the VIX and the VXN, which has many neutral readings and have not gone much up or down and is in a short-term trading range. As you can see, the 50-day moving average is in a neutral position. If we look at the contract itself, other than one spike up, it has been in a trading range. What we told you also with the short-term indicators, that we've been neutral for a while. And if you look at the short-term indicators, we've never really hit zero, and we're definitely not shorting at 100. And this has been a range for the last few weeks. What is interesting is the CCI indicator, which has the QQQs and spiders have been trading above the zero line. And again, do I think we'll hit the minus 200 level to become oversold in this market? I don't think we're going to hit it. I think we're going to come close to zero, bounce off the zero, go back up to 200, and keep seeing this thing go higher. But again, we're buying on any type of pullbacks, and the pullbacks are not that good. We go to the next indicator, overbought, oversold indicators, short-term, medium-term, and long-term. Again, if you look at these indicators here, we are not getting an opportunity on the oversold to get in. Something that worked very well last year was the components of the overbought, oversold. Like a broken record, we are neutral on this. Now, getting to the very important Magnificent Seven, which has clearly last year been the leading factor. But as we talked about, some other sectors are coming up. We are very heavily invested in Nvidia and the AI sector, as we're also seeing pretty good gains in Meta, Microsoft, and Amazon. But there is a but. Apple and Tesla are on declining phases out of the Magnificent Seven. So 2 out of the 5 of the Magnificent Seven are in declining. What's also a negative factor, we always say how Apple goes, the rest of the market goes. This is something to be concerned in the future, that Apple and Tesla are not performing well, and the stage analysis of the QQQs is not higher than the 50% mark. If we look at the double AII market sentiment ratio, it is bearish, but it's been bearish since the beginning of the year. One day this will come into effect, but not today. If we look at the put call option, another sign of greed, and we are bearish. If you go down to the stock price strength, another bearish signal. Today, as we speak, the Ridex Fund's Nova Ursa ratio sentiment indicator is in a neutral reading. You know our stance. We are bullish. We are invested heavily in artificial intelligence led by Nvidia, ARM, AMD. We are in cryptocurrency, Bitcoin, Ethereum. But this brings to us a reason. Why are we so sure this year will be an up year? And it comes down to the presidential election cycle theory, thus saying that we are in a fourth year, which is the third best year compared to last year, which is the first best year, which saw the market go up pretty well. And we believe this year will also see the market go up. So you know the catchphrase, study it, analyze it, adapt it. Peace.